Hey everyone, welcome back to Corporate Decoder, the place where we will be pulling back the curtain on some very interesting documents today. Looks like Mountain Lake Acquisition Corp, the SED, has filed some paperwork with the SEC, and let me tell you, this one is packed with details that might make your head spin, but we are going to break it all down for you. Before we get into the nitty-gritty of this filing, if you appreciate getting straight insights from corporate documents without the jargon, make sure you are subscribed. We also have a Discord community linked in the description below where we talk about these filings and much more. So what are we looking at here? Well, this is a registration statement on Form S-1, which is basically a company's first official filing when they want to sell stock to the public. Mountain Lake Acquisition Corp, THU, is a blank check company also known as a SPAC. Essentially, they raise money from the public with the sole purpose of acquiring another company. They have not picked a target yet, meaning they raise the funds first, then go searching for a business to buy. This filing is from November 2025. The company wants to raise about $261 million by selling 26.1 million units. Each unit is priced at $10 and comes with one Class A ordinary share and half of a redeemable warrant. If you buy a whole warrant, you get to buy a share for $11.5. Now let's talk about the people behind this SPAC. The sponsor is Mountain Lake Acquisition. Sponsor the C and its managing members are Paul Grimberg, who is the CEO and chairman, and Douglas Horlick, who is the CFO. They, along with other independent directors like Jeffrey Michael Marquez and Aime Visa, have an extensive history in business and finance. They have experience with other SPACs, which can be good or bad depending on how those went. Looking at their prior SPAC experience, they were involved with Mountain Lake Acquisition Corp, which raised $210 million and is currently in talks to merge with Avalanche Treasury Company LLC. They were also involved with Social Leverage Acquisition Corp, which raised $345 million, but that deal was terminated and the company subsequently dissolved. So you can see there is a mixed track record with their past ventures. The company highlights its competitive strengths, which include access to a wide range of potential businesses thanks to the management team's vast network. They also boast a proven track record in value creation through operational expertise and deal execution. They claim their management team has negotiated and closed over 100 complex transactions. Their strategy is to find a solid company and then use their expertise to help it grow. They are looking for businesses with a leading industry position, stable free cash flow, and management teams that are committed and capable. They will conduct a due diligence review to understand the target business thoroughly. Now let's dive into the financials. As of October 2025, Mountain Lake Acquisition Corp, the SU has virtually no assets and actually has a working capital deficit. Their total assets were just $56,800, while their total liabilities were $52,945. This is typical for a SPAC before its IPO. The important part is the as adjusted column, which shows what the company's financial picture will look like after the IPO. Their total assets then jump to over $262 million. This is largely the money they are raising from this offering and from the private placement units purchased by their sponsor and BT. The amount held in the trust account is a huge chunk of this money, about $261 million. We also see a table showing net tangible book value per S-share. Before the offering, it is essentially zero given their limited actual assets. But after the offering, it is projected to be around $7.12 per S-share, assuming no redemptions. This $7.12 is the tangible value of the company. Per share, after all the IPO related costs are factored in, assuming everyone buys into the IPO without taking their money back. The difference between the $10 offering price and this $7.12 net tangible book value is the immediate dilution in the investment for new shareholders. It is about $2.88 per S-share dilution if no one redeems. But things get wild if people redeem their shares. In a maximum redemption scenario where almost everyone wants their money back, the net tangible book value per S-share drops to a negative $0.37. This means that if a lot of people redeem their shares, the company would have to pay out so much cash that their tangible book value per S-share becomes negative. The dilution figures swing dramatically depending on how many shareholders choose to redeem their shares. If 25% of potential redemptions happen, the dilution is about $3.48 per S-share. If 50% redeem, it is $4.45. And in the maximum redemption scenario, it is a whopping $10.37 of dilution per S-share. This is a critical point for investors to understand the value they are getting versus what they are paying. A major risk highlighted concerns the founder shares. Our sponsor bought 10 million of these shares for just $25,000 or about a quarter of a cent per S-share. This is a huge discount compared to the $10 per S-share public offering price. This means that even if the company does okay, our sponsor is likely to make a substantial profit solely due to this massive initial discount, even if the stock price goes down after the business combination. This creates a powerful incentive for the sponsor to complete any business combination to get its investment back, even if it might not be the best deal for public shareholders. They also mention a risk about being classified as an investment company, which comes with a lot of regulatory headaches. To avoid this, they might liquidate the investments in their trust account and hold the funds in cash. This could mean less interest earned, and therefore less money returned to shareholders if the SPAC doesn't find a deal. The warrants themselves are also a point of concern. There are a lot of them, and their terms can be adjusted, which could be disadvantageous to holders. If the company issues a lot more shares to fund the deal, the value of existing shares and warrants can be diluted. A legal detail worth noting is that disputes between the company and its shareholders will be handled in the Cayman Islands courts. This is a common practice for Cayman Islands incorporated companies, but it can make it harder for us investors to pursue legal claims. Looking at the actual financial statement as of the 31st October 2025, right before the IPO, they report total assets of only $56,800 and total liabilities of $52,945. Their shareholders' equity is a mere $3,855. This is essentially a shell company at this point, with most of its funds held in trust after the IPO. The statement of operations for that short period also shows a net loss of $21,145, primarily due to formation and administrative expenses. This is all very standard for a SPAC at this stage. It is all pre-revenue and pre-operations. An important contingency is the sponsor's agreement to be liable for certain third-party claims that could reduce the funds in the trust account. However, the filing notes they haven't verified if the sponsor has enough assets to cover these potential claims, which introduces another layer of risk. So what's the big story with this Mountain Lake Acquisition Corp? The C filing, it's a classic SPAC setup with a lot of emphasis on the management team's experience and networks. The financial tables before the IPO show a company that is essentially a vehicle for raising capital. The real meat is in the post-IPO projections and the risks. The dilution from the founder shares is a significant factor to consider, making the sponsor's incentives potentially misaligned with public shareholders. If a deal isn't perfect, investors need to be aware of the redemption rights and the potential for dilution, especially if many shareholders cash out. The company's strategy hinges on finding a valuable business to acquire and hoping their management team can execute. The risks are substantial, as with any SPAC, including regulatory hurdles, market volatility, and the inherent challenge of finding and successfully integrating a target business. The potential for a loss of investment is high if a suitable business combination is not achieved within the specified time frame. Ultimately, this filing paints a picture of a company at the very beginning of its journey, with significant potential but also significant risks driven by its structure, its leadership's incentives, and the broader market conditions. Alright, that wraps up our deep dive into Mountain Lake Acquisition Corp, the second's filing. What are your thoughts on this SPAC IPO and the potential risks involved? Let us know in the comments below if you found this breakdown valuable. Please give it a thumbs up and subscribe for more corporate investigations. And remember to join our Discord community, linked in the description, to keep the financial conversation going. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.